Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Reports Weekend Show. Corey and Shad here, your hosts for this weekend edition. Man, oh man, what a crazy week it was. It was Tariff Week, or Liberation Day as it was called in the US, and it caused absolute havoc in the markets. We talk a lot about what these tariffs meant and other geopolitical news throughout the week on our daily editorials. So on this weekend show, I really want to focus on the charts for all the traders out there. And quite frankly, I think charts are very important simply for investors as well. Whether you want to play the long side or the short side of markets, we need to pay attention to what the charts are telling us, even though there is a lot of volatility on the back of tariffs and geopolitics. It seems like nothing else really matters for these markets right now, especially when we come into a week like we just went through, where everyone was waiting to hear what Trump had to say about reciprocal tariffs, and he delivered some pretty big ones around the world. We're going to kick off the show with Dana Lyons. Dana is a fund manager and the editor of the Lyons Share Pro website. Dana, I want to ask you kind of a game plan strategy here. You have been on the show for years now, outlining what your internal models tell you and really focusing on the charts and explaining why you try to ignore this other news that impacts markets, but you find that sticking to the charts keeps a more level head and also keeps you on the right side of trades. What is your game plan, being a technical trader, considering markets are moving so much off of tariff news and geopolitics?
Yeah, thanks, Corey. I think more so than even the charts, the market, the underlying market data that we use in our models and our quantitative models really is critical in orienting our investment posture, whether we're not just buy and hold, take what the market gives you. We're going to strive to be aggressive at the right time and defensive at the right time. And the way that we do that is through some quant models that we've developed, which really, and we've talked about this in the past, they basically measure which way the broad market, the majority of stocks are moving. Are they headed upward or are they headed down? And if the majority of stocks are going up, then we can be more aggressive and aligned with that. If the majority of stocks are going down, then certainly we want to be more defensive. And since our risk model turned negative in early to mid-December, our model's has stayed bearish since then and has really been a crucial guide, as it always has been, in helping us stay rather defensive over that time. So that's really our guide. And as far as charts are concerned, when we're deciding where we do want to be invested, as far as investment selection, we go to relative strength and see which areas are outperforming. And even in the context of a correction or a negative market, there might be junctures within those key relative strength names that we want to take a stab at, and we'll go to the charts for that. And also, which is certainly relevant now, there might be certain levels on the charts where, our risk model is bearish, the overall environment is negative, but there are certain levels where, especially when sentiment gets so extremely fearful, that we want to take a stab at maybe adding some exposure around the vicinity of a potential turn. So we will take stabs at that. But again, the key for us is staying on the side of the market. Many studies have determined about 70 to 80% of the direction of a particular stock or sectors based on the direction of the overall market. So we do our best to try to not fight that trend, that overall broad market trend, and really stay aligned with the market.
Well, Dan, I think you do a great job. We've been following you for years, and I think your models and that kind of approach keeps you on the right side of the trade more often than not. I would assume with the volatility we're seeing this week, we're recording this on Thursday, the day after Liberation Day. And the markets are down big. We're seeing 3 to 4% moves down in the major indexes. A lot of stocks are down even double digits individually. The VIX is spiked up to 27. It's up 27% today. And so there's a lot of volatility in the market. I would imagine your medium-term quant models haven't factored that in since they're based more on weekly and monthly action. But when you look at the technicals for what you see, are you looking at this as kind of a exhaustion point in the selling, or how close do you think we are to possibly one of those turns you were mentioning?
The one thing, especially after just coming off of all-time highs not too long ago, I would say the one thing that we pointed to in recent weeks, especially in terms of something that might be at the backs of maybe a tailwind for the bulls, at least, would be sentiment, which has gotten obviously extremely negative and fearful. Even before Liberation Day, sentiment was to the point in many surveys and many real money indicators that was sufficient in terms of potentially providing the not catalyst but environment for a bottoming process, at least in the short term or intermediate term. So those conditions were already in place before the tariff news hit. So those conditions don't guarantee a turn. Obviously, the sentiment, even as bad as it was, can always get worse. And we saw that obviously after the tariff news, sentiment and fear levels really have accelerated and gotten even more egregious. So when those conditions are to the point where they are conducive to forming a low, meaning enough people have sold or enough people are hedging that even in a sell-off, there aren't enough investors to come in and sell that'll push the prices down that much, or they're hedged enough where it doesn't do that much damage and we can turn around and rally. That was arguably or potentially the case over the last couple weeks as we formed an initial low in March and then retested that low the beginning of this week and recovered that low. And one level we're looking at specifically in the S&P 500 was around that 25 or 55.20 level that did get recovered. So we were looking at that area as a potential bottoming level. So even though our risk models are still pointed south, you could take a stab there. But again, as we've seen with sentiment, and you noted, sentiment can always get worse in the near term. So even if those conditions are in place from a sentiment perspective to provide that environment for a bottom, if price doesn't agree, price can get a lot worse before that next bottoming potential can occur. So from our perspective, we took a stab at that 55.20-ish level, getting long there. But once that broke, you have to be disciplined enough to be hedged or out at that point. So once that broke, we got substantially hedged again. But I will say again, the one thing that the bulls have in their corner right now is sentiment that is so dour that it could provide the conditions for potentially a potential low nearby. But again, price is truth, and you have to stay disciplined to that.
So while low sentiment or extremes in sentiment, whether high sentiment or low sentiment, can indicate that either a high or a low is in for the market, if we also combine that with oversold conditions, close to where we're at for something like the S&P right now on a daily or weekly basis, Dana, can't low sentiment and oversold conditions, while we may be due for a bounce, is there a potential here that it could also signify that we are entering some sort of a bear market or a longer term protracted market?
Yes, it could. And as you know, that's our expectation for the long term, is that it's going to be a very, very difficult investment environment overall over the next probably 10 years or so, based on what we call background indicators, or the general market valuations and investment levels, which are basically, or at least in recent months, have gotten to all-time extreme high levels. So from a standpoint of overvaluation, overinvestment, and just excessively overbought levels, we've arguably never been this egregiously risk-laden in the history of our market. So, but that's a long-term thing. In the shorter term, timing of when that kicks off is always a little bit uncertain. So it is possible that this is the big turn, in which case oversold prices can get much, much more oversold and bad sentiment can get much worse. So maybe that is at hand, which is why, like I mentioned, you have to stay disciplined to not trying to continue to pick a bottom when the data doesn't back you up. So we don't have the evidence right now, for example, in our risk models to back up a strategy of continuing to try to pick a low and get more aggressive here. We can pick spots here and there, which from a technical perspective, we might get a shot at it. But if we don't have the backing of our quant models, then we want to, for the most part, stay defensive because, like you said, it's possible that, okay, if we are turning or shifting from a secular bull market to a secular bear market, this might be just the start of it. So I would say, even in a secular bear market, except for those, the meat of those bear markets where it's just a waterfall selling, it's not straight down. So you do get decent intermediate term lows where you can play the bounce. But right now, you got to be very disciplined about what spots, what levels that you're going to take a stab. And like I said, for us, for example, on the S&P, when that 5520 was broken, that's a sign to get extremely defensive and focus on capital preservation.
Well, Dana, what you're saying makes sense from the quant model standpoint. You want to see those turn before you get more aggressive. But if it is a secular bear market, there are counter trend rallies. For people listening to the show that are shorter duration traders or maybe intermediate term traders, when you're looking at just the technicals, if we put the quant models aside and you just put your technical hat on and you look at the charts, when you're looking at bottoming processes, are you looking at things reclaiming moving averages before you get back in? Are you looking at Fibonacci levels as far as a retracement? What kind of technical tools do you use when you're looking at a chart to figure out if possibly something has bottomed and is ready to ratchet back higher again?
Yeah, sure. So good question. And obviously there's a lot to unpack in that. There are two different really methodologies for trading technicals. One's really a trend following, and then you also have the mean reversion. So trend following, you're assuming you're still in a bull market and you want to pick support levels where you think you think that the markets should bounce if you're still in that environment. On the other hand, if you're in a different environment, then those quote unquote support levels become less reliable. They cease to become support, and then you're shifting to a strategy of selling the rallies instead of buying the dips. So you have to kind of decipher which environment you're in. So obviously we've been in a kind of a buy the dip mode for a long time, but if we're shifting, then you have to shift course. And I know you said you got to put your quant models aside, but we have a hard time doing that because that helps us orient our strategy in terms of, are we in a buy the dip strategy or are we in a sell the rip mode? So that kind of guides that philosophy. But just from a broad perspective, if we're buying, we want to continue to see higher highs and higher lows from an entry point standpoint. Maybe we do adopt more of a mean reversion type of strategy for picking entry points, but we still want to see those higher highs and higher lows, which is threatening to be undermined here this week, given the recent news. And I would say, just from one more standpoint, in terms of picking the bottom, what we see at a typical intermediate term low, you see an initial low like we saw in March. And then you see a dead cat bounce like we saw, and then a pullback and a retest of those initial lows that very often get undercut like we saw at the beginning of the week. What we want to see in those undercut moves is kind of a divergence in momentum. So you want to see momentum readings that are less oversold. And then from the data standpoint, you want to see data that's really less egregious. So, for example, you want to see a fewer number of new lows in the market than you saw at that initial low, and that was for the most part the case at the beginning of the week. And you want to see, for example, a volatility market. You want to see volatility spikes that are lower than what we saw at that initial low. And those were really in place. Those conditions were really in place at the beginning of the week for a intermediate term low. After quote unquote Liberation Day, the weakness we're seeing then, now we're seeing an expansion of new lows, which is not a good sign if we're looking to find a bottom. And we're also seeing volatility that is, again, testing the highs that we saw back in early March. So that is also not a great sign as far as trying to find those divergences that are evident at market bottom. So absent that, those conditions would suggest, okay, maybe we are beginning potential another leg down. So that would be certainly some red flags if I'm trying to pick a bottom here.
So Dana, let's move into individual sectors then. As much as we've talked how you look and use technicals and different indicators, are there any sectors out there right now that are standing out to you because A, they're either not going down or you see them actually continuing to move higher, that they have an uptrend in place?
Yeah, there are. Some of it is because longer term, they're in a decent technical position. They haven't suffered any breakdowns really from that standpoint. Some of the energy stuff looks fine. Financials, I think, look fine. And then some of the defensive names. It's interesting that they always say that, okay, there's always, somewhere to hide. And to some extent, that has been the case this week. You look at consumer staples, which are up nicely in a severe down tape, and a couple other kind of sectors or subsectors that have held in there well, and in fact we're hitting new all-time highs at the end of the week. Insurance stocks are at just off of all-time highs, and the utility fund that we're in, FXU, is trading at all-time highs as we speak. So there are areas that I wouldn't say, if we continue this nasty route, that I would be confident that they would continue to hold up. But there are areas you can continue to hold, and if we get pullbacks in those areas that are still what we would consider relative strength, we'll look for good entry points to add to them along the way. But again, as I mentioned, 70 to 80% of the direction of a stock or sector is due to the overall market. So I would say don't rely on that relative strength necessarily saving you from the rest of your portfolio, which might be getting severe damage laid into it. But there are some areas that I would say have not broken down and are holding up quite well.
Yeah, Dana, nice to see the defensive areas of the market acting defensive. They're doing their job. Another area that's in the defensive sector is the precious metals. Gold has continued to break out higher highs the last couple of weeks, and even this week we've seen some new levels. So it's another defensive area where people are going to hide. What do you make of the technical setup in gold? Is it getting too stretched here, or does it have more room to run?
Like we've talked about gold, we've been very bullish on gold for a long time. We don't see any reason to not continue to be bullish. It has run a lot, so we have a hard time really, allocating a lot of new exposure there. But at the same time, we're not in any hurry to sell it. So basically, we're just sitting with that and riding the uptrend. On the other hand, we've also talked about copper and silver and why we considered them, much lower in terms of their investment attractiveness as far as we're concerned from the precious metal standpoint, just because they haven't really formed technically like gold has, and you're seeing that in this environment. The reason why they're less reliable maybe as a safe haven, but the charts were telling you that to begin with, that gold has held up extremely well, continues to hit higher highs, and the other two haven't really. They've bounced of late, but less reliable from that standpoint. So I would say, stick with the trend as far as gold is concerned. Again, with it being this extended, we wouldn't be too eager to allocate a lot new money to it, but we'd buy on decent pullbacks, but for the most part, just holding on and enjoying the ride right now.
Fair enough. That ride has continued to move it higher. It has been really the standout market in this whole turmoil that we keep seeing around the world, because even international markets that are getting hit now as well. Dana, we're going to wrap it up here. Thanks for providing some of those insights on what you look for in the charts and the indicators that you also find interesting that we should be focusing on here. It's a tough market right now, and extremely tough if you're trying to play the day-to-day swings, but keeping a level head, I think, does help. Man, oh man, it's who knows where this is going, though. Dana, again, thank you for your time, everyone. Stick around. We are going to be right back, continuing this more technical focus on the show, but switching more so over simply to the metals sector.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. We are continuing with this technically based show, now focused exclusively on the precious metals, as we're chatting with Jordan Roy-Byrne. Jordan is the editor of the Daily Gold on a regular basis. Jordan dives into the precious metals charts for his subscribers on his website, also through videos too. So I highly recommend checking out Jordan's website and some of his recent YouTube videos. Jordan, let's start off with gold. Look, gold has been on an absolute tear to start this year, and in all fairness, it's been on a tear for over a year now after putting in a bottom back in, let's just say, October of 2023. Gold has just been moving higher, almost month after month. I think there's only been about 2 or 3 down months in about a 14 to 15 month period here. And the start of this year has just been strong, taking out pretty much all kind of extension levels that people have been noting. Let's dive simply into the gold chart here, Jordan. What are you seeing? What's the potential of gold moving forward?
Hey, Corey. Yeah, so gold is trading up above, I believe, looking at it on the day we're speaking, 31.62 in gold futures. So it has taken out the 3,000 measured upside cup and handle target. And also there was a triangle breakout. And so that measured upside target was 30.50. So gold has gone above that. I don't have a good Fibonacci target handy. If you look at historic cup and handle moves, and these are kind of rough, they're not as pure as a cup and handle as the one that gold made itself. But those moves went from the measured upside target to the log target in 6 to 12 months. And so the log target just basically means a percentage target. So you're looking at the depth of the cup, the percentage, then measuring that forward. And so the log target, I believe, measures to, I think, about 3,900 to 4,100. For me, I think looking at the precise spots that I'm looking at, I think that measures very closely to 4,000. So that's the next target that I have. And then, of course, I know we'll talk about it, but earlier this month, the really big development was gold breaking out against the stock market, breaking out of a 4-year base, and gold also breaking out against a 60-40 portfolio. So extremely significant development, that particular breakout. But I do think we're coming into some kind of interim peak here. We've seen in the last week or so, silver has not been able to get above 35. Silver last week, about 3 or 4 days ago, did have a very strong day, and the silver stocks just did nothing. So the silver stocks are showing that they showed a negative divergence to silver as of a week ago. And so they're selling off. Silver has not been able to move above 35, and gold has just continued higher in the last 3 or 4 days. And you look at the last 3 or 4 days, the miners are basically at the same level. They've made no progress. While looking at gold now, gold's up almost $100 in that time period. So we're coming into some kind of a peak here. I know there's a few people out there saying this is some major peak. I think that's totally off base, but this should be some kind of, at least if you're a short-term trader, it's a significant peak. I don't know if it's going to be a peak for 2 or 3 months, 6 months, 9 months, 4 months, 5 months, something like that. But I think we're setting up for an interim peak here.
All right, Jordan. Well, we will get into some of the intermarket analysis on gold versus the equities and the 60-40, but just sticking with gold itself, I think it's also worth pointing out that it just made its highest monthly and quarterly close just at the end of March. But you've been writing to your subscribers about another significant development, and that's gold in inflation-adjusted terms. Now, a lot of people just look at the nominal price of gold, and I guess that's what most people look at, but you're looking at it in inflation-adjusted terms as well and see it starting to break out. So maybe just point to that as another good arrow in the quiver for the gold market.
Yes, prior to a year ago or so, I remember thinking, who cares about the inflation adjusted price? That doesn't matter. But I was really trying to find some kind of indicator and something that would track the miners fundamentally and something that you could put on a chart. And some people do use gold against commodities, like gold against the CRB. But I mean, that doesn't work as well because there's been years where gold has really outperformed commodities, but gold's been in a cyclical bear market, so that's been bad for the miners. So that doesn't pan out. But if you look at gold divided by inflation, that correlates really well with the moves in the miners, and that's because gold divided by inflation correlates really well with the margins that miners are generating. And that's the gold stocks. They don't follow the gold price. They follow gold minus their costs. And so gold divided by inflation is a really good proxy for gold minus costs or gold miner margins. So that's why it works really well and why you look at a 100-year chart of the gold stocks and you look at the inflation adjusted gold price, like they correlate just like, I don't want to say perfectly, but really well. Other than the 1960s, they correlate really well. So that's why the inflation adjusted gold price is really important. And that has broken out of a 45-year base. So that's lifting away from the 1980 peak. As far as the weekly price and the monthly price, I'm not sure about the daily price. And, we only get the inflation reading once a month. So it's really difficult to look at the daily price. But anyway, so the monthly price and the weekly price, the inflation adjusted gold price, have really broken out. And so looking at the miners and gold producers right now, they really don't, I mean, they are fine with the margins that they're generating right now. Like if you're looking at some of these companies, especially ones that are building mines and growing production, they can, even if margins just stay where they are, even if they go down 5 or 10%, these companies can generate some serious cash flow over the next few years. But that being said, you have a breakout from a 45-year base in the inflation adjusted gold price. And so that tells you that, the margins for miners could even get a lot better and a lot stronger in the next year or two, based on this breakout. So that, again, gold producers now, they don't need higher prices. Their margins are really good right now. They don't need anything to change. They're going to make a lot of money. But thinking about the inflation adjusted gold price in this breakout, I mean, they could get a lot better in the next year or two. So we could, doesn't mean you want to do anything reckless as an investor, but, we could be coming into, I don't know, maybe like a mini bubble or a mini mania in the gold stocks in the next few years. Potentially. I mean, potentially. Again, that doesn't mean you start buying out of the money calls and doing reckless stuff, but just looking at all this, I mean, we could be coming into one of the best environments that mining companies have ever seen in the next few years.
Yeah, what a different environment. Hey, it doesn't feel like all that long ago that we were talking about gold trading at the cost of production. Now it's vastly higher, and these miners are making a lot of money. But just back to gold here, Jordan, we've had some people make a comment that gold has had kind of a parabolic move. We don't usually hear this about commodities, let alone gold. Usually this is more what we hear about tech stocks. What do you have to say to those people that say gold has gone parabolic, and if there is a top, then it could be that maybe longer cooling off period, as you mentioned?
Yeah, well, I do think that it could definitely put in a peak here that holds up for, potentially most of the year. But we have to step back and look at a 50,000 foot view. Gold is 12 months into breaking out of a 13-year bullish base cup and handle pattern. Now, in addition to that, earlier this month, gold finally broke out and is pulling away against the 60-40 portfolio. Now, the other times that happened were similar breakout. They're not all exactly similar, but if we're looking at history, the other times that happened were 1930, you got confirmation, 1930, beginning of 72, beginning of 2002. What happened? You had a really good move for more than 5 years in the miners and in the metals, of course, as well, after those breakouts. So the fact that, again, gold's broken out of a 13-year pattern, it's broken out of a 10-year pattern against the 60-40. This has only happened now 4 times in the last 100 years. Anyone who is calling for a significant top in gold they are missing why this intermarket analysis is so important, because it's telling you that we are only in the very beginning stages of money moving out of tech stocks and conventional stocks and conventional assets as a whole and moving into precious metals. And that is what supports a real bull market moving forward for over a decade. We are in a new situation. Like in recent years and since 2016, we were in a different situation. So we are in a confirmed new real bull market now. And when you look at the amount of money that's in precious metals, I post some of these charts. Like you look at fund flows, you look at the capital that's in gold ETFs divided by all ETFs. It is near a secular bear market low. I mean, it's moving off it now in the last couple of months, but it is coming off of a secular bear market low. So if you look at all these factors together, we're in the early stages of a new real secular bull market. There's just anybody who's calling this some kind of a major top, they're completely missing this, and they just don't understand the history and the significance of what's happening to gold here in real terms. Again, this is the start of a real bull market. It's confirmation of a new secular bull market, and this is going to run well into the 2030s. Now, that being said, this requires some nuance because, we're coming into a real, if you're a short-term trader, we're coming into a significant top. As I said, this top could hold up for most of the year. But at the same time, some of the absolute best moves gold has made have been, it makes a breakout, then it comes back, tests the 200-day moving average, then it starts rebounding again. I think the last 3 times it's done that, it's made some really seriously strong moves to the upside. So I think you're going to see that again, because what's going to happen is you have a lot of people who think gold is putting in, let's just say, a more significant top than I'm saying. And what's going to happen is gold is going to correct. It's going to consolidate. It probably won't be as severe as most people expect. And when gold bottoms and rebounds, you're going to have tons of people coming into the market that were previously on the sideline, or they thought, it made a significant top. And that's going to drive like a real accelerated move to the upside. So we're coming into an important period now, because the coming months really could be one of your last chances to get in before this thing gets crazy. So there's a real risk after this correction that's coming up that things could really accelerate after that point.
Okay, Jordan. So I think you're really highlighting the importance of looking at things in different time frames. In the short term, maybe there's an initial short-term topping pattern where you have that correction, but to your point, historically, when gold makes the big move, then comes back and tests that 200-day moving average and then corrects, it then makes an even bigger move, which would put into the frame that log scale target you mentioned around $4,000 for gold. But then longer term, the secular bull market, because it's breaking out versus equities and bonds, it could keep going for years. So it could go to much higher levels than even that log target on the cup and handle. So when you look at the mining stocks, you're saying this pullback that we get could be one of the last chances to really load the boat. Give us your technical take on what's been happening in the gold stocks. I guess we can look at it by way of the ETFs, GDX or GDXJ. I know a lot of individual charts look different, but how are you looking at the gold stocks overall, and how will you be taking advantage of whatever corrective move we get?
Well, the gold stocks have just broken out from basically 4.5 year bases, depending at what you're looking at, whether it's GDX, the XAU, the GOEX. GDXJ is a little different, but that's still at a 4 year high. That has a little bit more to go, I think, before it breaks the 2020 peak. But, aside from GDXJ, all these minor indices, XGD in Canada as well, like they've had clear breakouts from multi-year bases. So that's extremely significant and really, really bullish at the same time. It's interesting because, even though gold could put in some kind of a peak here, it'll be really interesting to see how the miners act. And I have a suspicion they might act the way they did in 2009 and 2003, where there was a period early in those cyclical bulls where it was right, you had to move, and so it was right after the bottom. It wasn't at the beginning, but basically before the second leg higher, even though gold was consolidating and correcting, like the miners were really outperforming during that correction. Like I remember distinctly how in 2009, gold had the first initial rally after October '08 low, rallies up to 1,000. Then it consolidated for 4 to 6 months. But there was still buying in the stocks during that consolidation. The same thing happened in 2003, where you had for a time, gold consolidated. There was huge buying of the juniors, huge money was coming in. I think silver outperformed. And this was during a period when gold corrected or was moving sideways. So, even though, like, if you're just looking at the miners in a vacuum, they look really good. They've had these huge breakouts. I know we're going to touch on breadth, but I'm not seeing any like major negative divergences there. And miners could, they could come back and retest these breakouts, but, I don't see any worry that they're going to drop 20 or 25% here. So they could, they could consolidate really bullishly, while we're having this pullback in gold. And maybe even they get bid at the same time because professionals are really underweight this market. And they're going to use any weakness, any correction to come in and buy. And that's going to keep, I think, the miners from having some huge drawdown here, even though gold can consolidate for a while. So obviously the miners are looking really good. I mean, the higher quality juniors have been on absolute fire for a while. You're starting to see money come into the, not necessarily low quality, but lower quality miners and juniors. And, I think assuming we get this correction, it'll provide a good opportunity for people to reshuffle their portfolio around, get allocated to some higher quality companies. And that's, that's my thinking over the coming months. I'm taking a look again at everything I own, stocks I missed. Maybe if there's something I missed and that corrects, I can get into that. But, if this plays out, I'm thinking it could be really your last opportunity to get into high quality juniors, especially if they come back, because if we see the next leg higher after this correction, you have, gold going to 33, 3,500, then silver breaking 35 to 37. Like you're just going to see a tidal wave of money coming into the sector. And it's going to be like what we've seen in the last month, but, on steroids or lasting for a while.
Man, that could be really good for the sector. But I think to your point, your comments on if gold goes through a little correction and the stocks don't get hit, that would be a huge change. Because one thing we have seen is gold or silver moving sideways, the stocks taking it on the chin. So that could be a huge divergence and a bit of a telltale sign. Let's talk breadth, though, because look, we hear a lot of people complaining that their juniors haven't moved. And I get it. There are a lot of juniors that haven't moved. But I'm seeing a lot of stocks out there that have done really well over this last year especially and just keep tacking on to their gains. What are you seeing in terms of breadth within the gold stocks?
Well, looking at GDX right now and looking at the new highs, one thing I look at is a 20-day exponential moving average of the new highs in GDX, although it's technically new highs divided by new lows. And so using this 20-day exponential moving average, like you can see the clear peaks, like the peaks in 2016, 2020. There was also one in 2019. Those peaks, those major peaks are around, I want to say 30, 33%. We are up, as of yesterday, we were at 18%. In 2024, you had quite a few peaks that were around 16, 17%. So we have not had that huge burst where we move up to 25 or 30% with respect to this 20-day exponential moving average. And I do have some data, but I can't share it with subscribers because it's a particular service. But we do see at the intermediate term peaks from 2000 to 2010, the 20-day exponential moving, it does tend to peak around the same level. So when you get to 25 or 30%, you're at an interim peak or probably an intermediate term peak. And so again, we're at 18% right now. So I really hope we correct and this comes back down. I really do not want to see gold continue to move up here, and the stocks just kind of drag higher while they're not outperforming gold. That to me would be a more negative thing. Another thing I look at is the percentage of, you can look at GDX or Huey. What's the percentage of the stocks trading above the 200-day moving average? And then I look at what is the 50-day moving average of that data. And interestingly, at the 2016 and 2020 peaks, that percentage figure, the 50-day average of it, was 97% or 99%. Now, as of a couple days ago, we were at 64%. So breadth to me is, and now there's a couple other indicators that are pretty hot. Breadth to me is pretty strong. It's good. But like I was saying, I really hope that it comes back here. And, we have a good correction for a couple months to set the stage for something bigger. Last thing I'll mention, the advanced decline line. Looking at the advanced decline line, I did mention this at the beginning of March when we had that low in GDX. You had a strong positive divergence in the advanced decline line. And so I remember I put out a flash update saying, well, I thought we were going to correct more, but based on the advanced decline line, it looks to me like, there's risk we're going to move a lot higher. Now, where we are here and now, the advanced decline line has started to weaken relative to GDX, but I wouldn't, it's like a tiny negative divergence at this point. So again, I really hope the market sells off sooner rather than later. I don't want to see the sector, I don't want to see gold keep trending higher and then the miners just suck wind, for the next couple weeks. That to me would be negative and set up a more, maybe a top that holds up for the entire year potentially. But, we'll see how it all plays out.
Yeah, Jordan, I agree. I think it'd be nice to have a cooling off period. You want to see 2 steps forward, 1 step back. You don't want things to keep racing higher or it ends up being a longer term topping process. But another thing we want to look at with regards to both the gold stocks and the silver stocks is silver itself. There's a super tight correlation between silver's chart and the GDX chart going back about a decade. So I think a lot of people are looking at silver to break out to see even things like the main ETFs break out even further. How are you looking at the chart of silver?
Well, the first thing I'd say is, I know that from a big picture, silver tends to follow the miners, but I wouldn't really, if you're assessing the market and really analyzing it, I wouldn't just base, the miners are doing this, they're breaking out, so this means silver has to break out. I mean, they're different markets. You have to be careful about using correlations. But yeah, so looking at silver, it all comes back to 35. I mean, 35 is monthly and quarterly resistance. So think of $35 silver as 2,100 for gold. So that's where we're at. There's a little resistance at 37 in silver, but after silver takes out 35 to 37, I mean, there's very limited resistance on its way to 50. So it's going to get really exciting when silver breaks 35 to 37. But that being said, you look at the action in the last week or so, I mean, the market's weakening, it's correcting. So silver has already hit its interim peak. And, I wouldn't be surprised if it, takes a while for silver to break 35 to 37, because eventually when it does, we're going to see a huge move higher. But, it's not going to happen in the next week or the next month. It's going to take some time.
Jordan, excellent technical update here. Thank you for continuing on with our more technical focused show, looking at markets and metals. Again, the metals continue to outperform, especially gold. Silver has been doing fairly well too, but even the stocks doing well on the back of that. If everything plays out the way that you have outlined here, could be a very good time for all the precious metals investors. I know that's encouraging to a lot of our audience. We'll see what the next few months hold, and if this momentum that, boy, oh boy, it has been a leap forward in gold, if that slows a little bit in the second quarter, even the third quarter of this year. Again, Jordan Roy-Byrne, editor of the Daily Gold. Click that link in the show notes. And everyone, thanks for tuning in to this weekend show. Please go back through our website, kereport.com, and our podcast and YouTube channel. Just search the KE Report for all our daily editorials and company updates from throughout the week. Thank you all again for taking some time on this weekend. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.